Hey, good afternoon. How's everybody?
Hello.
Yeah, hi, Yang Yu. Hi. Please feel free to unmute yourself. Okay. Ravina, I think you are um, dropping a line in the chat box, I think. Yeah, hi, Ravina. How are you? And um, don't just type into the chat box, but please feel free to unmute your microphone. So I see we have like 11 people. Actually, that's including myself. So actually, there are 10 students currently uh, in the Collaborate. Um, yeah, and Sophia, I think okay. So oh yeah, the connection. I think the connection is unstable. So, and we have actually 20 people on the roster, 20 people, and this means half half the classes uh, half the class is not on. Let me just quickly check the discussion board and let's see how many people are have reported to the today's forum. So at least we have 14. Actually, out of 14, the first two are mine. So maybe I'm not sharing this so you don't see. So let me make sure that I share. I'm sharing. Um, okay, share the entire screen. And you should be okay. Now you see there are like 14 in the today's forum. But out of those 14, two are my threads. So actually, there are 12 people uh, in the forum now. 12, and we have okay, good. 12 people. All of those 12 people are here because I see there are 13 attendees there. 13. That means um, excluding myself, there are 12. Okay. So, but still, I'm kind of concerned because people, as I said, there are 20 people on the roster, and this is the second day, and already the ramification, I mean the impact um, of missing classes is snowballing. It's not. It's snowballing. It's compounding. It's snowballing, right? Missing, already the first day is already critical. I already, gave you a head start by making the materials available on the 19th, a day before our classes started. But there's a lot of reading. I mean, when I say reading, that means really the uh, video studying. You study the videos. You must study the assigned videos, and you shouldn't let it pile up because you cannot catch up at the end. I mean, not just at the end. Already today, as of today, already as of today, uh, there are already 12 videos. Right? Yesterday, ROI part one through part six. That's 3 hours worth of videos, and today you have ROI and macro uh, 1 through 5, and so that's 2 hours 30 minutes, 2 hours and a half. So let's say you have to spend 6 hours just to watch this video, but then watching it is not enough. You must study it. You must follow the video, and if there is something that catch, then you should pause the video and replay, or you should research, the part that you didn't get, and until you fully, comprehend, you should study the video, play it over and over again, and study it inside out until you fully understand it. Okay? Please don't expect, don't think, don't come to the class thinking, oh well, sitting in the collaborate session and just listening to the professor, that should do it. If you think that way, no, you are grossly mistaken, because this class requires a lot of hard thinking, and a lot of hard thinking takes a lot of time, your own time. You have to study and think over and over and over. You have to analyze the question. You have to analyze the statement. You have to use, logical reasoning and analytical reasoning to fully comprehend the statement. Okay, so it takes a lot of time, your study time. It takes a lot of your own study time to keep up with the class. Okay, the class is not just limited to the collaborate session, 2-hour 15-minute collaborate session. Okay, it's very limited. What we can do during the collaborate session, during the class, is very limited. Okay, and that's why this collaborate session is basically for reflecting on the pre-assigned videos, right? So basically discussing the issues that were, materials and issues that were discussed in the lecture video. We do that. We reflect on that material and we discuss the material. That's what we do in the collaborate session. I can't reteach you everything all over, because teaching is done, teaching the material, lecturing the material is done in the video. Okay, if you expect me to teach it, what does that mean? That means, it just means, repeating the same thing that I already did in the video. Okay, so basically, waste, I put in a lot of effort, I put in a lot of time, I invested a lot of time and effort into production of the video, right, into the production of the lecture video. So it's exactly me teaching like that in class. And if you want me to do it, repeat it over in a live session, then it's a waste of that, it's double investment. In other words, if you're double investing, the investment is wasteful. I mean, if you double invest, the initial investment is totally wasted. Or the second investment is just a waste. It's just wasteful. So I don't reteach everything all over again during this collaborate session, but we reflect on this. I mean, these videos, right, ROI part 1 through part 6 were already pre-assigned already from July 19th. Okay, so you were supposed to do this studying or reading in advance and come to the class on July 20th, and then we just reflect on these videos, on this lecture material, right? Lecture content. So then tomorrow, because these are ROI and macro, these were assigned today. So you must finish watching these videos today until or by by the time before you come to the class tomorrow, so that we can reflect on these materials, on the lecture content um, contained in these videos tomorrow. So it's going to be a very time-consuming work and we will be like one day off. I mean, we cannot, because these videos are, again, ROI macro part 1 through part 5 are just assigned today, so we cannot discuss it today, right? Because you haven't watched it yet. And we haven't even finished discussing um, yesterday's videos, yesterday's lecture. So we have to pick it up from there. So reflection and discussion of today's videos, assigned videos for today, will have to be done tomorrow. So you must watch everything, right? You must finish watching. So I'm telling you, it's studying. It's basically studying. I heard dings already, a couple of dings. That means somebody is typing into the chat box. But please say it, because what you're looking in your screen, what you're looking on your screen is also what I am looking in my screen. In other words, you're looking at the lecture. You're looking at the lecture material, right? Isn't that right? You're looking at the. Can somebody confirm? You're looking at today's topic folder. You're looking at the topic folder, and you're looking at the videos assigned for today. Is that right?
Yeah.
Okay. So this is what I'm looking at. I don't have dual monitor. I don't have dual monitors. In other words, if I have dual monitors, then two monitors, then in one monitor screen, I will be looking at this, and in another monitor screen, I can monitor what's going on in the Collaborate. But unfortunately, I have only one computer, and I can only watch what's going on, just single screen. And I'm looking at the topics folder, right? So I cannot see what's going on in the chat box. So if you are typing in anything for me, there's no way I have to switch back and forth. So please say that. Please, speak up. Don't just, type it into but let me just,
Professor,
okay.
I have a question.
Yeah. Who is this? Abrobac or Abraham? Who?
No, it's a bull. I'm not them.
Abul. Okay, Abul.
My question is,
Mhm.
how, for example, each video is about 30 minutes per video. How should we break out for each lesson? Are you expecting us to watch all the videos? For example, for ROI, there's 6 videos, and that's about 3 hours. Are you expecting us to
Yes,
watch
that's
all
right.
3 hours for
Yeah.
each session?
Because look, I'm squeezing in because our class runs, actually our class is scheduled for 2 hour 15 minutes, but there's no way we can cover everything every day by just assigning 2 hours worth of video. We cannot cover everything by the end of the semester, right?
No, I understand that.
So yeah.
My
So
question
remember,
is, if, for example, the ROI, which is this week, it's from, I guess, yesterday to tomorrow, it's 3 days.
yeah,
Should we break
there will be
out the video 2 parts for each day, or should we have all watch all 6 parts.
You have to watch all 6. If
at
yesterday on the 20th, yesterday, 6 videos were assigned. So you have to keep track of what videos are assigned each day. Yesterday it was ROI part 1 through part 6. That's 3 hours worth, right? So you should, and this was not visible. ROI and macro was not visible. So whatever is visible on that, visible and assigned for that day, you must finish watching all of them. Okay? And I'm squeezing in like 3 hours worth of video into a 2-hour, 15-minute session. So obviously you cannot watch them during the class session. You have to watch them in your own time. Okay? And I said it will take more than 3 hours. I understand some of you may be working, you don't have 3 hours, but do your best. But and today, what is assigned? There are 5 videos assigned for today, ROI and macro. So that's one. That's today's lecture segment. That's today's segment. And tomorrow, the rest of them will be assigned. Tomorrow, you don't see this, but whatever is gray, that's for tomorrow. So you will be so. And then over the weekend, even if you didn't finish up everything, but try to finish up whatever is assigned for that day. Let's say playing it for the second time, watching it for the second time, for the third time. You can do that using the weekend. But it requires that much concentration. Okay, and as I said.
So in short, all the 10 videos is for this week, right?
There are more than 10. Look, yesterday and today, there's already 11.
Oh my God.
Right? There's already 11 just for yesterday and today.
And tomorrow.
And then tomorrow there's going to be 7, 8, 9, 10. So there will be total of 16 videos just for this week.
Okay, great.
Okay, and then I wonder if you have noticed I posted yesterday's session recording. If you have time, you can.
Yes, I watched.
Okay, someone may. I think someone dropped a line in the chat box, but as I said, I can't see it simultaneously. So if you have urgent concern, please say. Okay, so Abraham, was that you? Is it 6:14? Well, that was already like 7 minutes ago. So it may not be the. Okay, now, so let me. We couldn't quite finish the discussion yesterday, so let me pick it up from there. Because we were discussing, my mouse is acting up. We were discussing holding period return and how to. I think we stopped here, right? And then, so we were. I'm sorry. This is not okay. Give me a second. I'll have to change the battery. Otherwise, this isn't. Oh, I keep getting. Okay, let me. Okay, so this wireless mouse is acting up, so just change the battery there. Okay. So all right. So the thing is, the formula that you see, in the PowerPoint, in the slide. So are you looking at the PowerPoint now? Are you looking at the slide?
Yes.
Is that what you're seeing? Okay.
Yes.
So,
Yes.
okay, thank you for the confirmation. This is the formula for holding period return, and we understand what this is. The PT plus N minus PT is the capital gains, right? And the PT is the initial investment, right? Because that's the price of the asset that you paid, at time, at the initial time. And if the initial time is 0, right? Our next question is, what is this part? Now think about
Cash flow.
it. Someone said
Cash flow.
cash flow. Yes, you're right. But then, what is this cash flow about? Where is this cash flow?
So interest, income, and dividends.
Yes. Now, if you suppose we were using Amazon.com as an example, Amazon stock as an example. So if you buy a stock, right? If you buy, let's say, 100 shares of Amazon, right? If you buy a stock, then the stocks generally pay dividends, right? Stocks generally pay dividends. Dividend is like interest they are paying, but then it's a totally different concept. Why? Because first of all, dividend is not mandatory. Dividend is not a requirement. Okay, whereas interest is a requirement, because interest is the income from lending money. I mean, you won't lend money if there is no interest, right? And interest is the only thing you get, because if you lend $10,000 for 5 years, over these 5 years, you will get paid interest, right? Every year, it's either you get interest, monthly or annually, and then at maturity you get the principal back. Or another option is you don't get paid any interest until maturity, but at maturity you get both principal and interest all together. Make sense? And if you choose option 2, in that case, in principal and interest, getting principal and interest back all together at the same time, that's called future value. Future value, right? So either way, if you're getting, but either way, when you lend money, you get interest. If there's no interest, there's no reason to lend money, right? And also, if think about it, if you lend money, you are taking certain risk, isn't it right? You're taking certain risk. Who was that? Who said that is cash flow?
Sophia.
Who said, huh?
Sophia.
Who was that name?
Sophia.
Give me your name. Sophia. Okay. All right, Sophia. For that answer, you will get 0.25 point. Okay, Sophia. All righty. So, by lending money, you are taking certain risk, because the borrower, remember, the borrower's credit score represents what? The risk the risk that the borrower comes with. And if the borrower has excellent credit score, what does that mean? The borrower has very, very low risk, right? Excellent credit score, like 840, 830. I mean, excellent credit score by the going practice is that credit scores above 780. Credit scores above 780 is considered excellent credit score. It's like, I'm not quite sure, but less than 5% of the population or less than 2% of the population. It must be less than 5% of the population, entire US population. So if you have excellent credit score, that means you are a low risk to the lender. So the lender doesn't have to charge high interest. And if you are very risky, I mean, if your credit score is low, my understanding is that average credit score in the US is somewhere around 600, average credit score. And below 450 is a bad credit score. Low, below 450. But anyway, if you have a very bad credit score, then you are a high risk to the lender, right? So then they will have to charge high interest to compensate for the risk. Now, and when we say risk, what kind of risk are we talking about? In a lending situation, think about it. In a lending context, when we say risk, what exactly does that mean? Anybody?
Return on
The chance
payment.
that they might not get it back.
Okay, yeah. The risk of not getting the money back. Okay, the risk of who was the gentleman who's what did you say? There was a voice of a gentleman who said something. What did you
I
say?
said pretty much the same thing, not returning.
Yeah, but in exact
Is
words
it
that you use.
is it better for a bank to, or I guess, would an ideal candidate be someone who's somewhere in between less risk and more risk, if they can, have a higher interest on return?
Yeah. That's a good thinking. I mean, that's a good thinking. Okay, but that's not the exact words you used. What was the exact words you used?
Oh, the initial, I said pretty much what, I forgot her name, what she said.
Okay,
You have
that's fine.
yeah.
That's fine.
He said the
That's
risk of
fine.
not getting the
But
return on investment.
oh yeah. So that's the same thing. Not getting the return, but not getting the return and not getting the principal paid back are different, a little different, because return on the money is the interest. It's not only the interest that you are concerned about for not getting concerned about not getting back, but it's also mainly it's the principal and interest, right? So yeah, uh, who said not getting the money back? Who was that?
Sophia.
Oh, Safia. Okay, it's again you. So I'll give you a 0.25 extra point. And who was the gentleman who said? I mean, not because of who was the gentleman who's
A bull.
a bull? Okay, a bull. Yeah, it's a different story. But you said it would be ideal for the banks to target at the population segment that is between like low risk and a high risk. So medium risk range. Yeah, that's a very good point, because in terms of revenue, right? I mean, if your target market is too small, as I said, excellent credit rating people, the people with excellent credit ratings, how many are there? I mean, it's less than like 2% of the population, right? But although less than 5% or whatever, but although they are safe, but then you don't make much money by lending to them, isn't that right? Because there's small population of them. By lending them, first of all, the target market is small, and then interest you can charge is low. So this is not a very, this is a safe, potentially safe, target, but then it's not, there isn't much money to be made from this market, right? And then what about people in the medium range? I mean, obviously, high risk, population, population. They are, there won't be that many of them, but pretty much, more than the excellent score group. But this low score group, they have, you may charge high interest, but you are reluctant, but there's a big risk of not getting your money back, right? So the best, the optimal or the most marketable target group would be people with medium credit range, right? People in the medium credit range. So once again, for that answer, I will give Abul 0.25 because that's a contribution. I mean, that's a logical thinking, right? That's a logical reasoning, and for logical reasoning, I give, I'll give 0.25. And once again, so the there's a name, there's a word for this risk. I mean, risk of not getting your money back. Risk of not getting your money back. But there's one word for that. I mean, it's two words. The second word is risk, but what would be the first word? Anybody? What are two words that describe, that sum up the risk of not getting your money back?
Would it be default?
Yes, it's called default risk. Default means what? Defaulting, it's, being insolvent, so being unable to pay back. So you default on your loan, that means, you are unable to pay back. So default, who said that?
Christopher.
Christopher. Okay, Christopher, for that. Yeah, I'll give you 0.25. All right, that's called default risk. So when we say risk is generally, that risk means default risk. Okay, in lending context. So, but in stock, if you put your $10,000 into Amazon stock, it's not lending, right? You're investing, and when you are an investor, I mean, when you are a stockholder, when you're investing in stocks, then it's different from lending. Lender has an obligation to pay back. Lender has an obligation to pay back principal and interest. But if you invest, the company that got your money, right? They have no obligation to pay back, right? You are totally doing that. You're totally taking your own risk, right? So if the stock, so you paid $100 per share for Amazon, right? The worst case scenario is losing all of it. If Amazon stock crashes, and if it is zero, if it is now valued as $0, then what is your return? Can anybody tell me what's your return? If Amazon crashed and now it's only worth $0, what's your return? Anybody?
So how much does it
Zero.
normally buy it for?
Oh, you paid $100. You bought Amazon stock.
We lost our money.
Yeah, you lost all the money. So then, if so, it was $100 a share, and regardless of how many shares you bought, and in our scenario, we bought 100 shares, so that would be 10K. But anyway, whether it is $100 or 10K, if Amazon stock crashed and it is worth nothing, worth zero, it's the same. It's the same. It's all the same. It's zero, whether you bought 100 shares or one share. the return, rate of return in this case, is what? If it crashed and
0.
no, it's not 0, it's negative 100. Who said negative
Negative
100?
100.
Huh? Yeah, who said that?
Yeah, -1. Sophia.
Yeah, who
Sophia.
said that? Who said negative 100? Huh?
Sophia.
Safia again. All right. So I'll give you 0.25 for that answer. Yes, it's negative 100. If you lose everything, it's negative 100. Isn't that right? If the stock went up to 200, from 100 to 200, if the stock went up from 100 to 200, that's 100% return. It's positive return. But from 100 to 0, it is negative 100%. I mean, if it went up to 200 but went down back to 100, then what is your return?
-0.
No,
Or just zero?
negative
You
0.
can
There
say
is no
anything?
there is no such thing as negative 0. 0 is 0. There's no positive 0 or negative 0. If the stock was $200 and it went down to 100, what's your return? What is your return?
0.
No.
100.
100 the capital?
Yes. So $100 is the capital loss, but that's not the percentage. That's not the rate of return. So if the capital loss was 100, in other words, from $200 it went down to $100, then what is the rate of return?
-50, because you lost 50%.
Yes. Is there Safia again? Negative 50?
Yeah.
Negative 50%. You should say negative 50%, right? But was it Safia?
-50%. Yes.
Yeah, was it Safia? Who said
Yes.
that? Was it Safia? Huh?
Yes.
Okay, but Safia, I'm sorry. This time I cannot give you 0.25 because you should have said negative 50%. Negative 50%, right? Because if you just say negative 50, does that mean $50 or 50%? It's not clear. So please make sure in dollars, the capital loss, it lost or it went down $100, right? That's capital loss. But in terms of rate of return, the rate of return was negative 50%. Okay, makes sense. Now, then,
Professor, I have a question. So
yeah.
just to clarify this, you say we run the risk to invest $100 in a company, right? So if the company crash and then we have negative 100, right? So as a return money that I have left is going to be negative 50%. So as the company crash, I lost my 50%, and so I'm going to get back 50%, right?
Well, no. Listen, two different scenarios. And who am I speaking with now? Who am I speaking?
Ophelia.
Huh? Ophelia. Okay, Ophelia. Now, Ophelia. Now, first, if the company crashed, so if the stock lost all the value and stock value is 0, then you lost 100%, right?
Yes.
Your rate of return is negative 100%. But it even if the company crashed or a company did very poorly, then stock value will drop. But if it drops to from 200 to 100, that's negative 50% return. In that case, you didn't lose everything. It's simply your initial investment just got halved. Isn't that right? Because if this is the price you paid initially, if $200 is the price you paid initially, and the company crashed, but it's not that bad. Their stock is still worth $100. Then the rate of return is negative 50%. You didn't lose everything. You still have half you still have half the value of your initial investment. Make sense?
Yeah.
You understand? You lose everything only when the stock crashed to zero. Only when
Only
the
when
stock is
the crash to zero, I lose everything, right? Is that what
exactly if the price of the stock is zero now. In other words, if the company is completely, hopeless, right?
exactly?
Uh, uh, then there's no demand. There's no demand for that stock. If there's no demand for the stock, what's gonna happen? If there's no demand, there will be no price. You understand? The only reason there is uh, the price of $200 is supported is because there's a demand supporting that price. You understand? And but if there's no demand, if the company crashed, there's no, the company has, uh, the company is usually the case is a company's total asset value is, let's say, $1 billion, and then total, the company has, like, um, $1 billion debt. Okay, then by paying off that by selling the company's assets, then they can barely pay off the debt. If they barely pay off the debt, what does the company have left? It has nothing left because the company sold everything to pay off $1 billion, right? In that case, the company is now, what happens to the company? It gets dismantled. It gets because company has nothing to produce anything. You understand? If the company sold all the assets, when company goes down like that, uh, in the case like, let's say company's total asset value is 1 billion, but it has like $2 billion of debt. To pay off the debt, what will they have to do? They will have to sell everything that the company has, and the the maximum they can get by selling off everything that the company has is 1 billion, because that's what is declared as the total asset value. And that means company selling its factory, company is selling its plant, company is selling its land, company is selling its buildings, company is selling its equipment. And these are the physical assets that,
Assets.
yeah, assets that were worth $1 billion, but they had to sell it all to uh, raise $1 billion, to make $1 billion to pay off the debt to the lender. But remember, even if the debt is $1 billion and they barely paid off the debt, what is left of the company then? Nothing, right? They don't have a plant. They don't have an office building. They don't have land. They don't have production equipment. They have nothing. If they have nothing, they cannot produce anything. If they cannot produce anything, they cannot sell anything. If they cannot sell anything, there is no revenue coming into the company. So that company is done, completely done for. There is no way it can recover, right? And nobody is going to. They will try to borrow money and do whatever to. But who's going to lend to the company that has no asset? Who's going to lend to the company that has nobody? So uh, um, then in that case, value of the stock is zero, right? Because this company has no potential to generate any profit, right? Makes sense. And if uh, if it is the case where the debt the company has is 2 billions, but their total asset value is only 1 billion. Now think about it. Selling off everything to pay debt, to pay off the debt, there's no way they can pay off. They can pay only half the debt. The other half, the lenders lose. The lenders will have to the lenders will have to um, swallow that, right? That's because there's no way the company can pay off the other half. Make sense? So anyway, that is But that's the scenario that can happen. But again, we were talking about the dividend. Not once again, I said dividend is like the interest, but then it's different because companies don't dividend interest rate is an obligation because as a borrower, the borrower has an obligation, legal obligation to pay pay back interest and principal, right? But stock is not an obligation to the company. Stock is totally a voluntary investment in the company. As so, if you are investing, if you are buying Amazon stock, 100 shares by paying $10,000, if the price is $100, then you are voluntarily becoming a partial owner of the company, right? Because what does the stock mean? Stock means the ownership, partial ownership of the company, partial ownership. Okay, stock is the partial ownership. So, the total amount of dollar value of the stock that this company sold could be, let's say it is $5 billion or 10 billion. Make it simple, $10 billion. Let's say the company's total is called equity. Company's total equity, right? Which is the capital they raised by selling stocks, right? If it is $5 billion and you invest, so, and the market value of that, if there are two book values and market values. And let's say the market value of these stocks sold, the ownership is 10 billion, and you put part of it, the $10,000 is your share. That's why they call it share, your percentage in the ownership. But then that's a very, very small, very small ownership. Think about it. 10,000 out of 10 billion, 10,000 out of 10 billion, that's 1 over 1 million. Isn't that right? 10,000 over 10 billion, 10,000 over 10 billion, that's your share of the ownership. That's like 1 over 1 million, so it's like 0.00060, 6 zeros and 1, right? Or 0.00001%. Your partial ownership is only 0.00040 zeros and 1%, right? Makes sense? No matter what, but you are partial owner, technically, of the company. And if you're the owner is the one who is taking the risk. Isn't that right? Suppose you're running a small, suppose you're running a small coffee shop, right? And as the owner of the coffee shop, eventually and ultimately, the risk falls upon you. I mean, if your business thrives, if your business thrives and your business succeeds, then you reap all the benefit of the success. But if your business fails, as the owner, you take all the loss. You're not going to tell your employees to share that risk. I mean, the company. So your coffee shop failed, right? And so that means you got bankrupt. Why did you get bankrupt? You're not making enough profit to pay the debt that you have. Why did you have the debt? Initially, to start this business, you had to borrow money from somewhere. Isn't that right? To start the business, you have to raise capital from somewhere. Isn't that right?
Yes. I'm sorry. I'm sorry for interrupt you. What happened if I lost all of that money? And I still have a debt with the bank? what they do.
You lost all the money, meaning what? You lost all the money, meaning
Mean if my business crash and I lost
yeah.
all the
If
money
your
and I don't
business
have enough
crashed, that
money
means
to pay them.
once again, if your business crashed, look, what does that mean? Let's say you have this coffee shop, and the coffee shop sale of the revenue or income from running this coffee shop is dwindling. I mean, if it is thriving, you have after paying out expenses, and the expenses will be what? Uh, Salary, wages to your staff, and then um, rent, right? Rent for that space, and then uh, the cost of coffee, the cost of electricity and things like that, right? Cost of coffee beans, right? So
Employee,
basically, huh?
employees payment. You have to pay
No,
them.
I already said, wages to your employees. That was already said, right? And then rent for the space, the rent that you are, the space for the space that you're renting, uh, and um, basically material cost. Otherwise, the material cost, like coffee beans,
Inventory.
water, supplies, things like that, right?
Yeah.
Electricity, I mean, using, gas or electricity, utilities, right? And they depend on, so think about it. If you generate, listen, if you generate enough income, right, then you must generate more than those expenses. Make sense?
Exactly. In order
Yeah.
to have enough money or earn.
Yeah. In order for the business to survive, right? In order for the business to be viable, you must generate more revenue than the expenses. And those expenses, after those expenses, then what do you need to do? You have to pay interest to your lenders. Why? Because to open this coffee shop, you borrowed money from the bank or from some lender. Make sense? So there is, on top of those expenses, um, there is no interest payment, right? In this case, we are assuming that you pay back the principal at the end, at maturity. But so just every month you pay interest. So then, even after paying interest, you should still have something left. You should still have something left. And from the something left, you must also pay taxes. Make sense? And then you should still have something left for yourself. That's called what? If you still have something left after paying taxes, then what is that called?
Profit. Profit.
Profit, yes. So think about it. If this profit, as long as you have positive profit, your business isn't going to go down. Okay? And even if you have like zero profit, you have nothing for yourself, but business can stretch. I mean, business can go on. I mean, you just don't have anything to live off, right? But then that situation cannot last long. And next case, you have negative profit. Let's say if you have negative profit, what does that mean? You are not making enough. Your business is not generating enough income to pay those expenses, the interest, and to pay taxes. Then, if your business is losing money, uh, that means, if it is negative, that means somebody is not getting their cut. Somebody's not getting their cut. Either the employees are not getting their cut, or the employees are not getting their um, pay, or the the bank is not getting their interest, or the government is not getting their tax revenue. I think about it. Employees, you can lay off. I mean, if you cannot pay them, you can lay off. right? You can lay off the employees. But if it is the bank, can you postpone paying the interest? If it is the bank, is the bank relenting? The bank is not relentless. You understand? Employees you can lay off, but you cannot lay off the bank, right? And then taxes to the government. I mean, if your profit is, if you don't have positive, if you don't have positive leftover after paying the debt, then if your profit is negative, you don't pay taxes because there is no money to pay taxes. Make sense? So the government won't kill you for that because you have zero profit. Then the government cannot impose taxes on you. Your business is losing money. The government is not imposing taxes on you. Taxes only on the positive. It's called, positive, EBT, earnings before taxes, right? Earnings before taxes. That's the profit before paying taxes, right? And the final profit is called net profit or profit or earnings after taxes. So if your earnings before taxes is negative or zero, then there's no taxes. You can't pay taxes, and government won't enforce it. But lender is not relentless. Lender will pursue you to get their money back. So in that case, what's going to happen? They will take you to, you would have to either declare bankruptcy or the lender will take you to bankruptcy court. And why would the lender take you to the bankruptcy court? So that they can seize hold of your assets. You understand? They are not getting their money back. So what do? They take you to the bankruptcy court and get the bankruptcy judgment, and then the court will give you the right to seize the assets, seize your assets. So then, if you have like a coffee machine, I don't know how much it will be worth, but if the debt you owe the bank is, let's say, $1 million. Whatever is gonna make $1 million, they will sell it off. They will auction it off. Let's say you have, they cannot come after your personal assets, but if the business is a corporation, they cannot come after your personal assets. But if it is a corporation, they will seize everything. You have a car, not in your name, but in the company's name. In the company name, right? They will seize the car. You have a truck in company name, they will seize it. You have a building in the company's name, they will seize it. You have plant in company name, they will seize it.
They take everything.
Yeah. If it is a personal business, they can come after your personal asset, but if it is a corporation, they cannot come after your personal asset. They will sell off everything, right, to get their $1 million back. But of course, if it is less than all the assets they sell, if it doesn't come to $1 million, then they will have to swallow it, right? If it is only $700,000, then they will have to make do with $700.
Yeah, you touch a very
$300 will enter their balance sheet as or in their income statement as their loss. Okay, so again, so basically, if you are buying stocks, you are taking the risk as partial owner. And I told you, so stocks pay dividends, right? Stocks pay dividends, but the dividends are different from interest because interest is an obligation. It's a legal obligation, but dividends are not. So not all the companies pay dividends. You understand? It depends on how profitable they are. If they are profitable, they will pay out dividends. Okay? So dividend is basically coming out of the profit. And because you are entitled to a small fraction of that profit, because you are a partial owner. You understand? right? So dividend is, there may be or may not be dividends, but so I label this cash flow at time t. Okay, so let's think about lending money. If you lend money, you will get interest either monthly or quarterly or annually. Just to make it simple, it's annual interest. Okay, and annual interest is not a different concept. I mean, the bank, the borrower can pay the interest monthly or just pay interest just once a year, or if you sum all the monthly interest, 12 monthly interest that you receive, then that's annual interest, right? So the idea is, suppose you bought the stock, Amazon, so it's $100 5 years ago, and it's $100 when you paid. It is now $200. Okay, so I think it is now $200. So in that case, capital gains is 100, right? And over 5-year period, let's say Amazon paid dividends, and they paid, and if they pay dividends, it's always dividends are quarterly. But if you add them up, if you add up 4 quarterly dividends, then that's annual dividend. Isn't that right? Makes sense? Anyone? Yeah, if you add up 4 quarterly dividends, that's annual. And assuming that Amazon has consistently paid dividends, right, for 5 years, then there will be 20 quarterly dividends or 5 annual dividends. Make sense? So apart from
Yes.
Yeah, okay, good. Apart from capital gains, there is additional income that is coming from dividends or interest payments. Make sense? And that Greek character sigma, that means you are summing up everything. So here, starting from time 0 all the way to time n. And in our example, n is 5. Isn't that right? Because you bought Amazon stock 5 years ago, and 5 years later, capital gains. There was capital gains of $100, and during this five years, basically it's like this. So what this means, t running from 0 to 5, and cash flow at time t, that means cash flow at, Okay. So what it means is cash flow at time 1 plus cash flow at time 2. You get the idea. And the cash flow at time 3, cash flow at time 4, and cash flow at time 5. Okay? So what does this mean? Think about it. Although it's starting from time 0, right? There is no dividend. There is no dividend at time 0 because you don't get dividend as you buy the stock. You get the dividend 1 year later. Okay, or actually you get the dividend quarterly, but as I said, we assume, we are assuming um, annual dividend by adding up all 4 quarterly dividends, right? So at the end of the first year, there will be annual dividend in year 1. At the end of the second year, there will be annual dividend of year 2. At the end of year 3 and end of year 4, end of year 5. And this is, if I do this, and cash flow is a more generic notation, because if I call it dividend, then it will be only limited to the case of stock. If I call it dividend, it will be only limited to the case of stock. But I want it to be more universal. So then cash flow is a better term. So, but think about it. I can write it like this if I have only 5 terms, right? If I have only year 1 through year 5, I can write it like this. But if it is like 100, let's say I'm keeping the stock for 100 years. There will be dividends for 100 years. Writing it this way is totally tedious, right? You have to write 100 terms like that. Do you understand? Right? So we don't want, that's very inefficient. So we don't want to be inefficient. So the efficient way of expressing it is using the summation sign. By using the summation sign, as time runs from 0 to 5, we are summing all the cash flows at time t. So that means, when t is 0, then there is 0. Actually, there is no CF at time 0 is 0, because there is no dividend at the beginning of the year, at the beginning of the holding period. But when t is 1, it's going to be CF1. When t is 2, CF2, CF3, CF4, as t runs from 0 to 5. So is everyone clear about that?
Yes.
Yes.
Okay, only 2 people? Only 2 people? Only 2 people? Okay, so now we're going to come back to this example later, because there is a interesting, oh, it took a lot of time. It's 7:10. So we're going to look at this house value example later, but let's take because it's 7:10, let's take a quick 5-minute break, because I cannot keep going like this, because I'm losing my voice actually. By next Monday I won't be able to even speak. So let's take a quick 5-minute break, and then we'll get back at 7:15. Okay.
Okay.
Okay, reconvene it.
Right.
Okay, it's 7:15 and we're back. That was very brief. Okay, is everyone back?
Yes.
Okay, good.
Yes.
All righty, all righty. So now we understand, we get the concept of holding period return, and as I said, holding period is not. It can be any length of time. It can be any length of time. It can be 10 years, 20 years, or 3 months, even as short as 3 days, right? Hold, but the point is, um, uh, it the return has to be, even if you're holding any asset for 3 days, uh, the rate of return must be always expressed as annual. It must be um, annualized. For example, let's think about something like this. So you bought Amazon. You bought, it's not. It sounds like Amazon is actually like Amazon stock ticker is AMZ, I believe. Amazon. Let me just quickly check. No, it doesn't really matter. Let's Amazon stock symbol, stock ticker is AMZ. Um, so you bought Amazon, and your friend bought, let's say, Tesla. So when you bought um, uh, so let's just make it simple. So you were holding Amazon for 5 years, okay? So the price that you paid was $100, and the price now is $200. Okay. Let's make it more interesting. 100. So this is also 100, right? So you're holding pure, and ignore the dividends. Let's say there was no dividend, so this part is zero, because if there was no dividend, right, then this thing is zero. And also assume that your friend bought Tesla. It was, but then in our case, our return is 100%, right? Our holding period return is 100%, right? Yeah, let's say n is 5, because that means our holding period is 5 years. And your friend bought Tesla, and Tesla really grew a lot in the recent years. But then, suppose Tesla is 400 now, but when he bought it, he paid $100. So then what is the holding period return? And also assuming that Tesla didn't pay any dividends. And actually, Tesla never paid any dividends. What is the holding period return for Tesla? Anybody?
3%?
Come on. Huh? Say that again. Huh?
3%?
3% only? 3%?
300.
300. Sorry, 300%.
300%. 300%. Okay. Who was the gentleman that said 300%? Who was the gentleman? Speak up, please. I can barely hear you. Abul?
Gabriel.
Gabriel. Okay, Gabriel. Okay, Gabriel, I will give you 0.25 point for that. Yeah. So it's 300%. So you might say, oh, who did better? Who do you think who did better? Who did better?
Your friend with Tesla.
Yeah, it looks like, your friend, who bought Tesla, but suppose he was holding this for, if N was 15. If N was 15, how would you say? How do you compare?
So
What
and
does that mean?
so Amazon was for 5 years.
Amazon, yeah, you held it for 5 years, but your
And
friend Tesla, he
for
held it for
15.
15 years. So this 300% growth is over 15 years, whereas this 100% growth is over 5 years. So there can be no direct comparison because you can roughly say because it's 100% over five. It's 100% over 5 years, and the other one is 300% over 15 years. So it looks like you did better, right? Because you got 100% in 1/3 of the time. But then, isn't it roughly the same? But it took 3 times. It took 3 times longer for him. It took 3 times longer for him, and he got 3 times more return. So if it took you 15 years, I mean, if you were holding Amazon for 15 years, wouldn't you have done 300%? Huh? But again, think about it. Amazon and Tesla didn't behave the same way, right? No two companies behave in the same way, and especially they are in different industry, right? Amazon and Tesla are in different industries. So you cannot say, oh, if I held it for 15 years, I could have done 100%, or if he held it for only 5 years, he might have done also 100%. So we are even. No, there is no such comparison. There can be no such comparison, right? So the only thing, so when the holding periods are different, different, you cannot make a direct comparison. So what do you need to do? You need to annualize. Okay? You will need to annualize. But then annualizing means, okay, so this was 5 years. So by annualizing, does it mean, if I simply divide annualize, does that mean dividing 100% by 5? Does that mean this? Now, if that's the case, then to annualize this, then do you divide 300% by 15? And that's gonna, is that the case? No. First of all, this is pointless. This is meaningless. Why? Because if you do that, they all come to 20%. But and besides, this is not the way the asset values grow. This is not the way the asset values grow. So I don't know if someone's talking or if it is my voice echoing, but there certainly is some background noise. So if you are not speaking, and if your microphone is unmuted, please keep it muted. Now, so obviously this is wrong. Why? Annualization is not like this. Annualization is basically finding average annual growth, but then you don't do it this way. Why? This is not the way the assets grow. So this is wrong. This is not the way the assets grow. So here's the thing. Now, annualized return. So then how do you do that? To find annual, so think about it. If the returns are all annualized, then you can easily compare who did better, right? Because it's, on annual basis. But then how do you how do you annualize the return? How do you annualize the holding period return? It's actually, we have to use geometric average, not a simple arithmetic average. So what is, then we need to distinguish the concept. So what is simple average? There are three different types of averages, right? One is arithmetic average or simple average. Arithmetic average or simple average. And this is what you generally understand as average. Okay? And another is weighted average. And the other one is geometric average. But geometric average is also kind of weighted average. Geometric average is geometric average is also called time-weighted average. Time-weighted. In other words, there's a time factor there. So to understand this, simple average is simply like adding up all the numbers and dividing it by number of data points. For example, you want to find average household income. You want to find average household income of your neighborhood. Then what do? You first have to collect the data of each individual household income in your neighborhood. Isn't that right? And in your neighborhood, if there are 100 households, and you take the survey, you have to take the poll or survey. Of course, some people may cooperate, some people may not cooperate, but assuming that everyone answers honestly, and some people may have zero income. Some households may have zero income. But the idea is, let's make it simple. So 10 households in your neighborhood, and then each has like 50,000, 60,000, 70,000, 0, 20,000, 30,000. You collect the data. And then what do? Add them up and divide it by 10. Make sense? That's just simple average. That's what you understand as average. But it's not in reality, right? There are situations where simple average is not appropriate. Well, simple average is not. Why? Let's take a look at the concept of weighted average. So a good example of weighted average is your GPA. Why? I wonder if everyone understands well how GPA is calculated, but it's like this. Suppose you took English and math and some ethnic studies and art last semester, right? And let's say you got B plus in English, B in math, A minus in ethnic studies, and A in art. And grade points are B plus is, let's say, 3.5, B is 3.2, A minus 3.7, A 4. Then you might think, oh, because I got B plus B, A minus A, so I add them up and divide it by 4. I add them up and divide it by 4. This is exactly what is done here. If you add them up and divide it by 4, then you will come to 3.6. But then this is wrong. Why? Because this is simple average. It's only simple average. But why is simple average wrong? It's because it is not taking into consideration the weight of the credit. Okay, now you may have noticed that there are 4 credit courses and 3 credit courses. Most of the college courses are 3 credits, but math is always 4 credit, math. And these days it's hard to find 2 credit and 1 credit courses, but still in some ethnic studies, art and music, there are 2 and 1 credit courses still. And how many hours a week a 3 credit course meet? Does anyone know? How many hours a week does a 3 credit class meet? How many hours?
Well, it's a band because different classes is different.
No. Yeah, you can. Sometimes it. Sometimes, yeah, it's not always the same, but
Yeah.
you can say usually 3 credit course meets 3 hours per week. Understand? 3 credit course meets 3 hours a week. That's what. And by the same token, by the same logic, 4 credit courses meet 4 times a week, 4 hours a week, 4 hours. So math courses, all math courses, they meet 4 hours a week, and you earn 4 credits. Then 2 credit courses, 2 hours. 1 credit course, yeah, something like, there is a art class that meets just, that carries 1 credit, but generally 1 hour a week. So why are these why some courses have 3 credits, why some courses have 4 credits? It's because of the weight. And what does the weight mean? Weight means the importance. Why does the math class have to meet 4 hours a week? Because it requires that much effort. It requires that much brain power, that much brain activity, that much effort. And generally, all the other classes are 3 credits, right? So, what does that mean? You cannot equate math, one math class with one English class. You cannot, also think about it, you cannot equate one math class with one art class because their weights are different. So the B grade that you earned from math class cannot be equated with B that you earned from art class. You understand? The weight should be, the idea is the weight should be correctly reflected in the GPA, because if it is not reflected, the GPA will be skewed by less important courses. I mean, art, this art class, which carried 1 credit, because you got A, this will unfairly, and A is 4 grade points, right? 4 points. This A will disproportionately, you understand, disproportionately skew your GPA upward. Okay, does that make sense? So how do we correct for that? We will have to correct for that by weighting those grade points by the credits. Okay, everyone is fine with that? Everyone is fine with that concept?
Yeah.
So, yeah, okay. So this column is the weighted grade points. So 3 times 3.5, 10.5, 4 times 3.2. Okay, my mouse is still acting up, so let me. But you get the idea. Those are basically, the result of multiplying this column. Those are the results of multiplying this column by this column. And then we take the sum. We add them up. If you add up these credits, that's 10. We add up these weighted grade points, is 34.7. Okay? Then what do? We divide this weighted sum by
10.
the sum of the credits. Yeah. And then you come to 3.47. So this is the weighted average. Okay? This is the weighted sum. You divide the weighted sum by. So the reason for that explains the reason for weighted average, because it is making a correction for different weights, right? Otherwise, it will be disproportionate, right? Something is there disproportionately affecting the whole average calculation, right? Disproportionate, it's affecting it disproportionately. So that's not right. So that is weighted average. Then the next question is, what is the geometric average? Geometric average is the average for accounting for time factor. So here, I'm still struggling with my mouse, trying to change the battery. So give me a few, like, okay, 1 or 2 minutes. Okay, I got the old batteries out, so pop in the new battery.
Professor, sorry.
Yeah.
If you could just repeat, I guess, the one part again. So I see how you got the weighted average, how you have the weighted sum, and then what was the step that you did after that?
Okay, so okay, I got the mouse now. I got the mouse working. All right. So this is the weighted sum, isn't it right? This is the sum of all the weighted grade points, right? So that's called weighted sum. And then you must divide it by the sum of all these credits, right? So divide this by this, then.
Oh, okay.
Okay, that's the weighted average. So taking a look at this math, it looks quite daunting, but you understand this concept. So let me put it there. So the simple average is sum of all these. Come on, where? Okay, here's the thing. The simple average is sum of all these x values, and x is a random variable, right? So x subscript I means there can be any number of x. Now there can be, that means our data values are like 10, 11, 14, 5. Remember the average income in the neighborhood. There are 10 households. So then that means I runs from 1 through 10. If there are 10 households, I runs from 1 through 10. And so there will be x1, x2, x3, x4, x5, right? x6, x7, x8, x9, x10, right? Each x represents household income of the household 1, income of household 2, income of household 3. You understand? So if you sum all those, household incomes, 10 of them, then you divide it by I. Dividing, that's like, not sum of I, actually 10. I'm sorry, that, okay, that's simple average. And to generalize this, if you generalize this, then, you can generalize like, these, I runs from 1 through n, and n can be any number, right? So n can be, 10, 11, 12, 20 something. But, the idea is you divide sum of all the household incomes and divide it by number of household. That's simple average. But then looking at the weighted average, it looks more daunting. But now you understand what this means. I runs from 1 through n. And then what is this? Weight of I times, so weight is what? In this case, n is 4. In this example, n is 4. Everyone is okay with that? In this example, n is 4, right? Because we have 4 observations. Right, everyone? We have 4 observations, so n is 4. And xi is the grade points. So the first one, first observation, in other words, x1 is 3.5. Weight of x1 is 3. Okay, 3 times this, which is this. Okay, actually, I'm sorry. To represent it as weight of English is what? Weight of English is what? Isn't it 3 over 10? Weight of, out of this total, weight of English is 3 over 10. Isn't that right?
3 out of 10?
3 over 10. Yeah, you can say 3 out of 10, but let me put it this way. So in that example, in that weighted average example, what is being done is, so weighted average is like, I running from 1 to 4, right? 1 through 4. And then weight of I times xi. So then, weight means what? Out of 10, right? Weight means out of this total, right? Weight of English is 3 out of 10. Make sense? Or 3 over 10. So 3 over 10 times 3.5. 3.5 is what? That's the grade point you earned in English, right? And then math. Wasn't it math?
Yes.
Yeah.
Math 4.4.
Yeah. The weight of math is 4 out of 10. Isn't that right? Weight of math is 4 out of 10. 4 over 10, right? 4 over 10. 4/10 times 3 point, was it what? 3.25? 3.2?
Just 3.2.
3.2, yes. Yes, 3.2. Can you read that out to me? You cannot see. And then
For African literature, it was 2 over 10 multiplied by 3 over 7. Multiplied by, sorry.
okay, 2 over 10 multiplied by what?
3.7.
3.7. And then
And then R is 1 over 10
Yeah, 1 over
multiplied by
10
4.
times, okay,
4.
yeah, times 4. Now think about it. This is exactly weight times x, weight of 1 times x1, weight of 2 times x2, weight of 3 times x3, weight of 4 times x4, right? But then we can simplify this, because it's all it has, what is the common factor? 1 over 10 is the common factor, isn't it right? 1 over 10 is the common factor, isn't it right? Then it all becomes
Yes.
3 times 3.5,
3.5
yeah, and 4 times
plus 4 times 3.2
3.2, right?
plus 2 times
And
3.7
2 times 3.7
plus 1 times 4.
plus, 1 times 4, which is just 4, right? Now then, what is this? Isn't that the same thing as doing, I'm not going to rewrite, I'm going to, this whole thing is basically what?
Sum of x.
Yes, but part of it is, this whole thing is this. But of course, um, we cannot say that this is weight, because weight is 3 over 10, 4 over 10. But you get the idea. It will be like repeating the. Oh, what is happening? It's moving. Okay. Eraser. So basically, what's in the this thing is the numerator of this fraction, and 10 is the 10 is the denominator or the divisor. So this is exactly how we calculate it, right? This is exactly this is the what? This is the weighted sum. This is the weighted sum, isn't it right? It's the weighted sum, and we divide it by sum of all the credits. It's the same thing. Make sense? So you can express it this way. If you express it this way, then it has to be expressed in weight, right? All these have to be expressed in weight. That makes sense?
Yes, Professor.
Okay. Now we have a big fish to fry. We have really a big fish to fry. But before we do that, now do you understand? Do you understand this concept? How do I get this? So simple average is a special case of weighted average where all weights are equal. If all weights are equal, think about it. What does that mean? If all weights are equal, it's all 1 over 4, 1 over 4, 1 over 4, 1 over 4. If the weights are all equal, then it's a simple average, because if weights are all equal, it's not 3 over 10, 4 over 10. I mean, everything is it's just like a dice. On a dice you have 6 numbers, right? On a dice you have 6 numbers. What is the probability of each number coming up? What's the probability of each number coming up or coming up on head? Can you tell me?
If one,
What is the
100%?
100%?
50% because it's heads or tails.
50%? How can you say?
Wait,
I mean,
talking about for
you have a dice, huh?
Oh, a dice. Oh, sorry, 1 6.
You have a dice. On a dice, you have numbers 1 through 6, right? So what is the probability of any number coming up? What is the probability? I mean,
1 6.
huh? Who said
1/6.
What? No,
1/6? Yes, 1/6. Who said 1/6?
Marielle.
Who said 1/6? Huh?
Marielle.
Marielle. Okay, Marielle, you get 0.25 for that. Yeah, because they all have the same probability, right? A dice is a perfect cube or unbiased, fair cube. Fair cube means every side, it's a perfectly designed, I mean, it's a perfect cube, so every side has the same probability. So then, obviously, the probability of number 1 coming up, probability of number 2 coming up, they are all the same. And in that case, how do you take the average? You take the average by adding up all the numbers, 1 through 6, and dividing it by 6. Or you multiply it by its weight, 1/6 times 1 plus 1/6 times 2 plus 1/6 times 3, and so on, until you get to 1/6 times 6. But what is that? It's the same thing. If you do it by 1/6 times 1 plus 1/6 times 2 plus 1/6 times 3, that is, you're doing a weighted average. But if you do it that way, eventually it becomes what? Because the numerator is all 1 is all 1/6, it simply becomes just adding up 1 through 6 and dividing it by 6. So what is that? Isn't that a special case of weighted average? That it's simple average, which then is so the simple average is the special case of weighted average where all the weights are the same. Does that make sense?
Yes.
Anybody? Okay, yeah, you understand that now. And if the dice was not a fair cube, so what does that mean? A dice is distorted. If the dice is distorted, then each side will have, if it's a deformed dice, each side will have different probabilities of coming up. Makes sense? But since dice is generally a fair cube, they all have the same probability. And so it's a special case. Simple average is a special case of weighted average where all the weights are the same. Right? Makes sense? Now, so we have to move on to the geometric average. And to do geometric average, I will have to use this example. This is a house value. And that's going to take a lot of time to do this. So let me quickly just, explain the scenario. Suppose, so this is the data of house value taken at the end of each year. Okay. So assuming that you bought the house at the end of 2005, you don't have to buy a house exactly at the end of 2005. You could have bought it somewhere in the middle. But then the house value is always observed at the end of the year, because end of the year, think about it. End of the year value is the final data. Why? Let's think about it. Let me show you. Okay. Okay. Now, are you looking at this Yahoo Finance? Is that what you're looking at? Tell me, are you looking at this?
Yes.
Okay.
Yes.
Berkshire Hathaway. This is one. I don't have Amazon, but I have Apple. I have Berkshire Hathaway. Berkshire Hathaway is the investment.
The company that owns Geico.
Huh? Say that again.
The company that owns Geico.
Company that owns what?
Geico.
Google? Google?
Geico. The car insurance.
Oh, yeah. Well, I didn't know that, but this is because it has a portfolio. It's Berkshire Hathaway's portfolio may include Geico as well, but what is more known fact about Berkshire Hathaway is its
Warren
share
Buffett.
is it's owned by Warren Buffett. Okay, I have how many shares? I don't know. Maybe I have some shares in Berkshire Hathaway, and so this is I don't think it's today. It may be that was at 11 something, but at market closed right at 4:02. And if you want to track the okay, let's go to historical data, right? And this is daily, right? Daily data, but I want to let's say last 5 years. Let's take a look at last 5 years. July 20 from 2016 through 2021, and then let's get monthly data, and I apply that. So the data is monthly, so you can see July 1st, June 1st, May 1st, April 1st. But starting from, so I have 5 years, and monthly data for 5 years. How many data points do I have? If I have monthly data for 5 years, how many data points do I have? Can anybody tell me how many data points do I have? If I have monthly data and for 5 years, how many data points do I have?
60.
60, yes. Who said that?
Ophelia.
Ophelia, okay, Ophelia. Yes, this is a common sense thing, but nobody even dared to answer except you. So Ophelia, I give you 0.25 for that answer. Yes, we have 60 data points. But then, and you might wonder, but why do we have so many data series? Like, oh, well, because there are 4 price points. Yeah, open, high, low, close, right? I'll get to adjusted close later. But then think about it. Why are they always, are they all, taken at the beginning of the month? No, actually, it's the end of the month. It's the end of the month, right? Why? Beginning of the month, this is only the way the calendar date is, the time point in the time point is expressed by calendar format. Although it says June 1st, this is not the price as June 1st. It's actually the price at closing prices at, think about it. Closing price is the end of June. Okay, this open maybe can be beginning of June, but then think about it. Even during the day, even during the trading of stock market during the day, there are also 4 price points: beginning, high of the day, low of the day, and the closing. Now think about it. Which is most meaningful? Which is the most meaningful price point? Which is the most meaningful price point? Beginning, closing, or open, closing, high, low.
Closing.
Which one do you think is, huh?
Closing.
Closing, yes. Who said that? Who said that? Closing. Who said that?
Sophia. Hannibal.
Ophelia? Ophelia again?
No,
Sophia.
there were 2 people who said
Sophia, okay. Sophia, you get 0.25 for it. Yeah, why is closing the most important? Because it's the conclusion of the day's market transaction, isn't it right? It's the conclusion of the day's trading. In other words, no matter how high it got, or no matter how low it dropped during the day's trading, no matter where it opened during the day's trading, they are all irrelevant. When market closes, closing price is the conclusion of the day's trading. Isn't that right? Closing price is the conclusion of the day's trading. So all the other prices are irrelevant. Make sense? Now then, you might wonder, July 1st, July isn't over yet. We're almost, today's July 20 something, so we're almost close. But for July, the month closing price is not necessarily the end of the month. It's the latest closing price. So today, as of the latest trading, closing price of the latest. So if it is 31st, July 31st, we really have the closing price of the month. But as of whatever data we have, the latest closing data is will be the closing price for July. But so that's why the end of the month or end of the year price is important, right? That's what is relevant. So here, back to house value. So suppose your holding period. So you bought the house in 2005 and you sold the house in 2016. And just for simplicity, just for our thought experiment, we assume you bought the house at the end of 2005. You paid 150K. And you held it for 11 years, and you sold it for $500,000 at the end of 2016. Then we can calculate. What can we do? This is P. This is P11. This is P0. Isn't that right? This is P0. This is P11. Right? Make sense? And we can find capital gains or capital loss during the period. And obviously, we had capital gains of 350K. Capital gains year by year. Between 2005 and 2006, the capital gains, that's capital gains. And then there's capital gains, which was negative. Capital gains. So we're going to come back to this data tomorrow. We're going to come back to this data, and we will work through this. We will work with this and try to find, geometric average to figure out what is the average growth rate or return in this by holding this house, okay, by buying this house and selling this house. So we still have 12 minutes left, but I don't think we can do any more because we cannot. It takes more time, and I have to also I have to also give some consideration to my throat. You understand? I had another class. 3 o'clock class, which also 2 hour 15 minutes, and then this class. Before that, I had a conference where I had to make a presentation. So the whole day, it's a miracle that I haven't lost my voice yet. But maybe next Monday, I may have already lost my voice. And also it's very painful. My throat is also hurting. So let's call it a day here, and I will see you guys on tomorrow. But please, by all means, study the videos assigned for yesterday and today. By all means, if you cannot, instead of watching TV, instead of watching YouTube, instead of watching playing games, please, even in sleeping. I mean, if you have a headphone, a wireless headphone, a Bluetooth headphone, just play it, and even in sleep, listen. Okay?
We don't have time for none of those things.
Huh? I'm sorry?
We don't have time for none of those things. We have a lot of video to watch.
Don't. Yeah. You have to watch these videos. Good. That's good. That's a very good positive attitude. Okay. And if you have a I'm saying if you have a Bluetooth headset, even in your dream, you keep playing that. Even in your dream, you may be studying in your dream. All right. All righty. So I'll see you guys tomorrow at 6 p.m. and class is dismissed.
Thank you,
Okay.
Professor. Have a good
All
night.
right. You're
Thank you. Have a
welcome.
good night.
All right. Take care now. Take care now.
All right.
Good night.
All right. Good night. Stop recording.